In 3, 2, 1.
Welcome everyone to this week's Trinity Talks. I'm Conrad Murray, a partner in the corporate team in Trinity's London office. We've been looking a little more closely in these sessions lately at M&A and investment opportunities of late, and diving into some of the detail around these transactions. Going back a week or two, Hugh Naylor and Conwy Lawson looked at warranty protection, and this week we're looking at warranty and indemnity insurance, which has, at least in my experience, become of increasing interest to buyers and sellers alike in the markets we work in. I'll be talking about some of the benefits of W&I insurance, but we are fortunate today to have Nao Kambaro of Lockton, who's going to talk about some of the commercial elements of warranty insurance and run through a case study or two to help understand how it may be relevant for our deals. But first, let's take a step back away from some of the detail. We thought it might, given everything that's happening globally at the moment, be a good time to see what's happening in the M&A sector in infrastructure in Africa particularly. There's clearly a lot going on, and I'm sure plenty of themes, trends, opportunities and risks emerging. And who better to update us than Rob Futter from Cresco. Rob, over to you. How are things at the moment in this space?
Thanks, Conrad. Next slide, please. So I think what we've seen is a significant increase in the opportunities. About early January, I think 60% of our work was sitting actually in Africa, with 40% in South Africa. We've unfortunately, I guess, or fortunately, depending on where you're located, seen quite a shift between the Africa and the South Africa mix. And I think that's largely been driven by the fact that COVID has more severely impacted some of the projects in Africa. Things are slower to get on the ground, mostly linked to, I guess, travel restrictions and that have to be lifted before some of the projects can further develop, as well as the ongoing increasing concern about Eskom and its ability to continue to supply the large users. So I do touch on the theme in the slides on sort of energy opportunities, but I believe that the infrastructure class covers more than that. I think what we've seen a lot is that even though captive power itself is very relevant for large mines or beneficiation, specifically in Africa and South Africa, we are seeing that associated infrastructure linked to this has also seen an increase in demand or project development. So with every thermal power plant on the continent, be it utility scale or offsetting a mine's demand, there also needs to be some sort of storage infrastructure, rail infrastructure associated. So alongside these energy projects, we're also seeing increased infrastructure development links. And I think here we're seeing less of the large scale pipelines that take 10 years, across 3 countries, need 3 World Banks and a number of DFIs to unlock. We're seeing a lot of niche infrastructure. Recently involved in a project in Ghana in which there was a HFO project being developed, but that also needed a fuel storage facility in the port of Takoradi to also be developed, along with offloading and onloading logistics change to improve the whole interface and reduce transport costs. Similarly, we've seen similar projects in Guinea, where yes, there is quite a few projects on the ground to provide generation, both renewable and thermal, to offset a lot of the mine demand. But in many cases, these projects are having to truck their thermal load, be it HFO diesel, across 2 countries from the larger deepwater ports. Whereas now, if we had a infrastructure in one of the main cities, we could probably reduce the transport costs by at least 30 to 50%. So more and more we're seeing these projects happen. Unfortunately, I guess to a certain extent, each of these projects is quite distinct and has its different investors or interested investors. So a lot of the investors now either like renewable or don't want thermal, or don't want to touch storage facilities, or like pipelines but don't like the stuff goes in it. So it's very difficult to mix and match the type of investor to the project at what we've seen. But very much in the African space, we believe that the large utility procurement programs and projects all due respect, have probably largely stalled or have been taken up by, call it Chinese funding or infrastructure spend. Well, I think a lot of those are starting to perhaps not be as viable as they were before. And we believe that the private sector is really where most of the sort of M&A type opportunities are, outside of sort of concessioning and repurchasing. And for a lot of the power solutions that have perhaps already been put in place, so utility scale as well as private, we are seeing a bit of churn in which the initial promoters or the initial equity investors are starting to look to up their IRRs by disinvesting and selling on to the more institutional investor now that the project has sort of been de-risked or achieved COD. So that's the African space. In South Africa, I think we see similar trends to the African space, with perhaps the difference being that it's probably more renewable and less thermal, because we still have a larger utility and we already have a fair bit of storage and other related infrastructure already in place in South Africa. And then, to be honest, a lot of those projects that could be associated infrastructure, unfortunately, are on government land, and South African PPPs have not been very successful, although there's a lot of positive talk in the industry. So a lot of things happening. We're seeing increasing M&A, increasing interest. Sometimes it's one step forward, two steps back, but we are substantially more positive than we were at least 3 months ago. Next slide, please. So this is a little bit of just Cresco's experience, but I think it also shows you sort of the general type of projects that we're seeing out there. So on an 80-20 rule, you end up in the usual jurisdictions for scale and opportunities. So the Tanzanias, the Kenyas, although we haven't done a huge amount of work there, the Nigerias, the Ghanas. Smaller projects in more unusual jurisdictions. You have Eritrea and Mali there, Guinea and a few others, and Malawi. But I'd say the two big markets that we see are, we do see quite a bit of potential M&A and project related work is actually Madagascar and Zimbabwe, where there's been a significant increase in the amount of projects. And I think that's largely due to the fact that private sector's just taken the bull by the horns and had to make these things work. A lot of the existing investors in these areas either have run for the hills, try to take their money out, but there does seem to be lots of new money coming to find a home and looking for these projects, which I think is creating a lot more potential premiums on existing infrastructure. And obviously, I think you pay a significant premium for a developed project or even an existing project, be it which across the sectors, than you are theoretically for something that's in development with a government offtake or a government involvement, which obviously makes sense because one is obviously operating whereas the other one isn't. But just on a pure premium basis, the risk to getting these projects over the line is so much harder, and that's why we're seeing a significant increase in M&A churn in existing projects or brownfield expansions than perhaps we were a few years ago, where greenfields were all the flavor and everyone was trying to set up corporates or projects associated. Next slide, please. So once again, I've split between Africa and South Africa. So I mean, South Africa is really, in our view, booming at the moment. As I said, we hope that a lot of these projects will end up from feasibility studies into real projects on the ground. But most of the large users or corporates are, due to either their own financial situation or looking to develop, have created a number of M&A opportunities. We have Sasol on the list there, which I think is an interesting example with their requirement for cash. A lot of their downstream operations have been put up for sale, which has created a lot of M&A opportunities, but as well as brownfield expansion opportunities, because the new investors coming in, I guess, want to look at more opportunities to leverage. And Sasol was an integrated company, whereas now the people and the buyers of this infrastructure, so some of the gas pipelines and the petroleum assets and things like that, want to make it more open, and therefore that allows expansion and as well as churn in their sector. But I think everyone is moving and someone's doing something. I think the other side of that is there's a lot of money also floating around, but in the South African space and generally also Africa, although the money in Africa I think is more linked to countries. And I guess the question is which money fits which project, and are they willing to reduce the returns to an acceptable level to make these projects work? Because as I said, the existing assets are selling at a significant premium. Greenfields projects are a little bit out of flavor at the moment. So a few guys are running after the same assets, and that's great if you're a seller. if you're of the asset. If you're a buyer, you need to probably be willing to take a little bit of a haircut from what you might normally have expected. Next slide, please. So I guess just to summarize, to be honest, there's an oversupply of funding and interest. Then, and I've used the word real bankable projects, but maybe financially viable opportunities is maybe another word for it. The increasing competition is definitely reducing equity IRRs. We're seeing more and more the fact that funding might not be the debt funding kind of comes in later, albeit if it's a corporate transaction, it's probably a bit easier than some of the project finance related ones. And that there's generally the equity is willing to take more risk, take the upfront opportunity, and then if you do the brownfield expansion or you have to sell off the debt or restructure the debt later, so it comes in. So I think the other bit that we've really seen growing substantially and a fair bit of M&A, definitely in South Africa, is rooftop solar. And I think the large reason for that is that there's no regulatory constraint. So NERSA doesn't have to do a regulatory generating license, but also everyone can do it. The projects are smaller in scale. They don't need large project finance transactions. And the type of asset itself is quite clean, easy to understand, low technical risk. So we're seeing a significant number of institutional investors actually shopping around trying to buy portfolios of projects. So, using energy again, 15 projects making up 15 megawatts of power. And yes, they're different rooftops and different warehouses, but it's below the radar. It's easy it doesn't need competition commission requirements and all those bits and pieces. So we're seeing a significant amount of activity in that space. And then the last one I just want to touch on again is the whole, because energy is really, in our view, what's really happening on the continent. I think mining is less so, albeit there's some brownfield expansions. The thermal storage and the infrastructure is a huge opportunity. And there we're actually seeing a combination of the storage operators and oil traders willing to come in and provide offtake agreements, which then creates the opportunity for M&A. A lot of the traditional sort of providers of or equity investors in these have potentially walked away and are looking to disinvest from some of these asset classes in certain countries. And this creates a brave new world of potential investors who are willing to come in and take some of these slightly underperforming assets, perhaps grow them, and then become part of the bigger value chain and create value from that. But to conclude, I think the world has changed substantially over the last 3-4 months, and we just hope the momentum continues. But if people think they're coming and getting good deals on viable projects and corporates, I'd be surprised. I think there are good deals out there for underperforming assets, but then obviously the risk return discussion is always there if you have to fix the toy before you make it work. Thank you, Conrad.
Thanks, Rob. Yeah, I mean, part of the reason for running this session on warranty and indemnity insurance and getting that update is obviously we're all looking at ways to make these deals happen quicker and indeed at all. And so, understanding how warranty and indemnity insurance works and the benefits of it is part of that. So just to go back slightly to a presentation we had a week or two ago on warranties and indemnities. Hugh and Conmi discussed them and their place in these M&A deals. Perhaps just a quick recap for those that missed the session. Obviously, warranties and indemnities are a significant part of any M&A transaction and are hotly contested and can be an important part either in affecting the price or indeed whether a transaction can proceed or not. The two key reasons, as many of you will know, for having warranties and indemnities in these transactions is firstly to encourage disclosure on the part of the seller. So that all the issues, all the skeletons can be dealt with up front before the parties commit to the transaction. And sorry, Simon, do you mind just changing the, thank you. And secondly, to underpin the assumptions that the purchaser is making when completing a transaction, which therefore affects the price and the risk allocation. And as I mentioned a little earlier, this aspect of an M&A deal is hotly contested in invariably all these transactions, and can often mean that either the timing of the transaction or the price, or indeed whether the transaction goes ahead or not, is affected. Next slide, please. The key problem, well, at least from a seller's perspective, of warranties and indemnities, is that they leave the seller exposed for a period of time after the transaction, usually around 2 years, and potentially longer for other warranties, and indeed for indemnities it can be for an even longer period of time. And it's for this reason that W&I insurance, warranty and indemnity insurance, can be helpful. Going back 2 or 3 years ago, we wouldn't normally have seen this type of insurance in these transactions, and certainly in the last couple of years at least, perhaps with an increased interest from insurers, and Neo will talk to that shortly, and also potentially because of a maturing of the M&A market in Africa. We're seeing a lot of second-hand deals coming through now, where warranty regimes form a large part of these transactions. For those reasons, we're seeing warranty and indemnity insurance become much more prevalent. So what are the benefits of this insurance? Let's look at it from the seller's perspective first. Simon. First and foremost, as I mentioned, one of the drawbacks, obviously, of giving warranties on the part of the seller is that they don't necessarily get the clean break that they had always envisaged when they sell their interest. Warranty and indemnity insurance, which essentially passes over that risk to insurers, allows a seller to at least get a cleaner exit rather than having a long exposure after having completed the sale. That means that they can, for the most part, use their proceeds that they've received as part of the sale immediately, and can obviously use those for other purposes, for example, distributions to shareholders or for other opportunities. Related to that, and I suppose a byproduct of what I've just said, is that it avoids the need for trying to deal with the complexities of that period after sale. And by that I mean that the typical escrow arrangements where a seller will need to, for example, put funds aside into a warranty escrow account to essentially back up those warranties are no longer required. And that reduces the complexity of the transactions, the costs of these transactions, and obviously allows the negotiations to continue unhindered without having to worry about the complexities around those escrow arrangements. And the third point on that list there, related to this again, is that the thorny issue that often comes up in these transactions goes as to the creditworthiness of the seller, of the seller's ability to be able to back up the warranty claims. And again, it avoids those thorny issues around parent guarantees or other forms of creditworthy support that needs to be given in order to back up the warranties. And again, as a legal advisor that's been often in the middle of these transactions, it's these sorts of things that can lead not necessarily to a breakdown of a transaction, although that does happen from time to time, but it does lead to animosity and can confuse many of the other issues in transactions where these particular issues remain unresolved. Next slide, please. And so that was obviously from the seller's perspective. From a buyer's perspective, if a buyer is concerned about the seller's ability to pay on a warranty claim, particularly, as I mentioned before, there is no parent company guarantee or other form of cover, then obviously W&I cover can reduce that risk. Practically, another important part of this, particularly in the sorts of transactions that we are involved in, where incumbent sellers need to remain involved in a business for a period of time, we find, and Nao, I'm sure, will be able to corroborate this, it allows a seller and a buyer to continue a relationship after the sale without necessarily having the complexities of a warranty claim between them during the period after sale where they need to actually work together. And this leads to the next point, which is particularly important, we see in the context of the infrastructure projects and deals that we're involved in, that where there is a financial event, a financial close involving lenders or other investors at a particular point, the last thing that they would like to see post financial close is a warranty claim between shareholders. And warranty and indemnity insurance obviously allows the parties to at least mitigate some of the issues around that, where there is more of an arm's length relationship between them after the transaction. And just a smaller point there as well on auctions, although we have seen on those types of transaction, buyers can often differentiate their claims by looking to W&I cover to improve their bids. So that's a quick summary of how we see things, at least from our perspective, on how this sort of cover has started to emerge from our perspective to try and broker some of the thornier issues around warranties and indemnities. But perhaps someone more close to this is Nao from Lockton, who's able to talk more comprehensively about the commercial side of things. Nao, is that you with us?
Yep. Right. That's perfect. Thank you, Conrad. And that was a very helpful background to this discussion around the use of the insurance. Just to your point, and anecdotally speaking to the potential scenario where you have shareholders or management roll into the business and the potential or the risk of bringing claims against them. We ourselves as a business, which have grown organically around the world, have always used this insurance. Principally, the business we're buying tends to be, the value of that business tends to be the people and their relationships. And we've always felt that de-risking a potential scenario where we're having to make a claim against those individuals for a breach of warranty was always a sensible way to take that forward. Less so in those scenarios around the inherent underlying risk, more around the danger of de-stressing a relationship that we're relying on to run the business. So that was a helpful scenario there. So as the title says here, warranty and indemnity insurance pulling together to get to the finish line. I think our objective and aim in any scenario where we're using warranty and indemnity insurance and some of the related transactional risk insurance products is that this as a work stream is complementary, seamless, and quietly working in the background with all your other work streams to add value and get you to the finish line. And we'll go through some of those in the scenarios and the case studies we have. Next slide, please, Simon. Just by way of demonstration, there is nothing overly exciting or strange around this. This is an insured transaction, which you'll all be familiar with. Here we have a buyer on the right, seller on the left. On the basis of the consideration flowing from buyer to seller, the business, its liabilities are transferred to a buyer, and in doing so, the buyer relies on the warranties and indemnities a seller is giving them. To the extent there is a breach of warranty, one of those warranties is untrue or inaccurate, or there is a claim under an indemnity, the buyer would bring the claim against the seller. Now, clearly there are inherent risks in that, and the two that always stand out for me are, to the extent the seller is still in existence, is it solvent? And also on cross-jurisdictional deals, there is always a concern around enforceability. So those two for me are always a strong motive and a strong risk in any transaction. And I think Conrad alluded to it, but obviously huge stress points in any deals are negotiating warranties and how do you deal with identified risks in the deal. Both of these create stress points for the commercial parties. Simon, next slide, please. So in turn, we look at an insured transaction and we can come on to the motives and the process and structures around this. But quite simply, by introducing the warranty and indemnity insurance, we're essentially looking at a counterparty swap. It's straight counterparty swap, the insurer stepping into the shoes of the seller. So in this scenario, more than likely, the buyer would be privy to the insured policy, they would be the insured, and where there were a warranty breach, that claim would be brought directly against the seller. Against the insurance company. So the motivation here, quite simply, if initiated by a seller, I think the primary motivation has always been the seller looking for a clean exit to limit any residual liability. They'll be motivated by the ability to make disbursements or a wish to reinvest the proceeds of that sale, and they've used the insurance. Historically, the buyer would have looked to potentially use the insurance because it was an auction process, and they may be able to sweeten their bid by introducing warranty and indemnity insurance. What would that look like? It would be essentially introducing the bid with the fact that the seller could walk away from this deal with limited residual liability because the insurance was in play. Now, on the next slide, we'll look at how the market has changed, but to set out the advantages of using the insurance today, the most positive one is it takes away the pain of negotiating the warranties. In many instances, the position negotiated under a warranty and indemnity insurance is a lot broader than what can be negotiated commercially with the seller itself. The solvency risk is obviously taken off the table or highly de-risked by the fact that most insurers are S&P AAA rated, and that's a requirement on brokers that we only operate with a minimum threshold S&P paper. Claims, to the extent you're in a claim situation, this is now a regulated business where insurers have to behave within the auspices and regulatory environment for claims of that regulator. And if and to the extent, and hopefully never in my experience have we had to litigate a claim, but it's something to focus on if you are negotiating a contract. It's picking an insured friendly jurisdiction to govern that contract. So the market space, which you see here in 2020, has significantly changed. If we were to look at this in 2010, there would have been no more than 6 insurers. I think from recollection, we would have probably had 4 or 5 insurers. Obviously, that was impactful in the sense that there was more demand than supply, and insurers used to drive the terms and conditions in the marketplace. So terms of coverage for warranties was limited. This was a very expensive product, and candidly, there was very little value in the insurance unless it was an absolute mission critical requirement. The real dramatic change in this marketplace, which finds us here in 2020, is the financial crisis of 2008-2009, which drove the need, highly motivated by real estate being exchanged, the need to use warranty and indemnity insurance because buyers had concerns around the solvency of sellers. And real estate as a class of business is largely benign. It's driven this market to the extent that actually counting this morning, it's not 24 insurers we have, I counted 28. This brings obviously huge benefits to users of the insurance, whether it's the seller or the buyer, but fundamentally competition has brought a great deal of competitive tension in the market, especially where we are today, given the events of the last 6 months. People are insurers are very aggressive in chasing down opportunities. It means coverage is significantly broader than it's ever been. Premiums are down at record levels. If you pay any attention to just capital in the insurance market, this is the one standout sector in the insurance market that is considered to be soft, where rates are very, very inexpensive for buyers of the insurance. And it also means, to huge benefit of everybody on this call, insurers have had to change their appetite, and they've changed their appetite by sectors and geographies. So I think, Conrad, you referred to the use of warranty indemnity insurance in Africa. I think 5 years ago, there would have been very limited appetite of 2 insurers and no more. I think the last deal we did, we received terms from 8 insurers, which is very, very encouraging. Simon, next slide, please. Hopefully this is clear to everybody, but just to talk you through some of the trends in 2020, and these will speak to the point I made around the insurance position can often be a lot broader than the commercial position a seller is prepared to offer you. So the first one is knowledge and materiality scrapes. The warranties Conrad referred to, many of those can often be qualified by materiality and knowledge. It means the ability to make a claim is limited, or it's not as broad as it would be if that warranty was given on a hard basis without the qualifiers. Now, in many instances, I will ask a client, if I'm acting on the buy side, to give me their most aggressive markup of the warranties, strike out the qualifiers, add any additional warranties they think they would like on this deal, and that's what I would use to go to market to negotiate coverage with. I'm putting the buyer in a position, the user of the insurance, where they're negotiating with the insurer and not the seller. This would be a classic, the knowledge and materiality scrapes, where we would look to strike out any qualifiers the seller's introduced. Seller's motivated to limit their potential exposure. We're motivated by trying to make the coverage as broad as we possibly can. So should the buyer need to, the insured, they can make a claim. This is it has a cost impact, but it's quite commonplace now. The second point, this is highly in favour of the seller itself, the nil recourse position. Now, I've made a distinction there between real estate versus operational, because that was a legacy position. But on all policies, it's quite standard now that it's structured that the seller has a nil recourse position, subject to a $1 cap on liability. They walk away with limited residual liability, save for fraud and willful misconduct. Whereas historically, insurers would have looked for the seller to have some skin in the game. That's no longer the case. For a seller, if you're in a position where you're selling, it's obviously highly attractive. Again, if you're in an auction process, which is the next point, it's again a helpful or a bid sweetener. Auction tactics. Auctions, especially in energy and infrastructure this year, seem to be aggressive auction processes, seem to be flavour of the month. And in doing that, and I'm sure you're all familiar with an aggressive auction process where they are looking to run a number of bidders in parallel to the finish line. Many savvy and strategic sellers are now using the insurance in tandem with that. What does this mean and entail? It means that they are using the insurance to present an advanced position to bidders that they have only limited work to do to complete the insurance policy. The advantages for a seller is, whereas historically they would have allowed the buyer or the bidder to run the insurance process, sometimes that process would create a gating item, a lag in time. By using it in tandem with the aggressive auction process, the seller then controls the timing. It means by the time it's presented to the bidder or the preferred bidder with days to run into exchange, it should be working concurrently with all the other work streams. Subrogation and split sign and close I won't pick up on here, only because they're quite technical and probably less relevant than the other points. The sell, buy to flip, bottom left-hand corner, I've already alluded to. 70 to 75% of our instructions typically come from a seller. Their underlying objective is to be able to present an insurance to the buyer as a preferred commercial recourse for breach of warranty. It's obviously motivated to give them a clean exit, but just to put it there statistically, it's probably the majority of the business we do is initiated by them. Synthetic tax, synthetic warranties. This is a really interesting development. We've been doing this on a reactionary basis for the last 10 years, but we now have a product with 5 insurers. This is essentially where you are buying from, in a distress scenario, a business out of administration, and the administrators can't or won't give you any warranties. We have an agreed suite of warranties that sit outside the commercial agreement, are appended to an insurance policy, and are effectively given to you by an insurer and not by the seller or the administrator themselves. It's giving you protection you wouldn't have without it. Standard exclusions, just reflecting on the slide I'd shown before, there are many standard exclusions, and by way of example, environmental matters would have been a historical standard exclusion, product liability, intellectual property, certain tax areas. These are all matters, of course, that we would have historically accepted as excluded. The market dynamics, the abundance of competition means most of these have now been carved out. So product liability, for instance, is an area that most insurers will cover. At worst, they will cover it excess of the existing insurances. On the last 2 points, they're both usual commercial limitations and both insurance limitations on your ability to claim. Historically, the disclosure of the vendor data room and the disclosure of your own due diligence report would have been excluded under the insurance policy. What does that mean? And this is the most worrying thing. Historically, where clients had made claims, not any of ours, thankfully, certain insurers would look to the data room and they may point to certain matters disclosed in the data room as qualifying that claim or carving it out. The position we have taken, and please be mindful of it if you use the insurance, it is always imperative that you look to carve those exclusions out, look to put the insurer in the position that they have to go away and list the matters they deem disclosed, either in the data room or in the due diligence reports. And then at minimum, you have the opportunity to negotiate those items with them. Next slide, please. I'm sure everybody wants to know and is interested to know what are the general terms and conditions of each and every of the insurance, the warranty and indemnity insurance. My usual position on this, and I'll just talk around these from a high level perspective. If and to the extent there is an opportunity and somebody, more often than not, it's Conrad who would contact a team like us, give us the high level details of the deal, jurisdiction, nature of business. We would provide a report setting out the predicted pricing and other terms and conditions based on benchmark, and we do that very quickly on the basis that many people have a need to have a discussion with the investment committee and whether the insurance is relevant. But to give you a sense of what limits do people typically buy, well, I could turn that around and say, what limits do sellers typically offer? If a seller is pre-packing an insurance policy, they'll obviously try and limit the insurance to the lowest possible point they can. The minimum entry point is 10% of the enterprise value. So if the enterprise value was 10 million for ease of reference, then we would be needing to ask for a minimum limit of 1 million. Buyers tend to look at anywhere between 10 and 30% of enterprise value, but the smaller the business, the higher limit they tend to buy. Policy excesses, which means the difference between zero and the point where the insurance kicks in, can be commonplace depending on jurisdiction and the nature of the business. Those are anywhere between 0.25 and 1%. So using my example of enterprise value of 10 million, that would be anywhere between 25,000 and 100,000. De minimis to match the materiality threshold of the due diligence reports, the claims period, the time limitations. This is one area we can push the insurers. So if the seller is only giving you 2 years for the general, 2 years for the fundamentals, and 5 years for the tax, it's premium neutral for us to secure from the insurance market longer limitation periods. So but certainly 7 years for tax and fundamentals, and we'd often look to stretch 2 years for the general to 3 to 5 if possible. And the premium is a function really of sector and jurisdiction. I've picked here what sits comfortably within the normal delta from the best to the medium range, so 0.8 to 1.5. Using the example I mentioned before, if you were buying 10 million of insurance for 7 years, it would cost in a fairly common jurisdiction where insurers are very comfortable 0.8%, up to 1.5. Oh, sorry, it would cost between $80,000 to $150,000. Please bear in mind, this can be heavily influenced by jurisdiction. We're looking at a deal at the moment in Brazil, and the rate as a percentage of the premium there is 4%. So for 10 million cover, they are paying 400,000. Next slide, please, Simon. And I thought it'd be interesting just to talk through very briefly, I'm conscious of time, some recent deals we have done in Africa. And W&I is in most instances, hopefully not tempting fate, fairly vanilla product. I think more interesting are some of the other contingent matters that deals throw out that quite often people walk away from and deal with commercially, or a buyer may be prepared to take it as their own risk. Hopefully these will give you a sense of what the market's prepared to look at and prepared to insure. So the first deal was a telecoms business, where we were pre-packing an auction process for a seller. The seller was a UK fund. They'd structured this business with a JV partner who was based in Brazil. That JV partner had gone insolvent, which had led to our client, the UK fund, acquiring 100% of the topco, the target business being based in Africa. Excuse me. In pre-packing the deal, the W&I was, as I mentioned, used as part of an aggressive auction process. I think the more interesting point in this deal, there was a serious contingent liability, which was based around existing litigation in Brazilian and Dutch courts. The topco was a Dutch entity. Fundamentally, in acquiring the joint venture partners' shares in this business, 50% of their shares, it was potentially challenged that it was a transaction under value, which is they bought the business at a discounted rate, which wasn't a fair consideration because they had taken advantage of their JV partner being in administration. The end result here was, fundamentally, our client, the seller, either had to provide a $250 million indemnity for a potential title claim, breach of a fundamental warranty, or we could find insurance to plug that. Incidentally, we found insurance at a hugely relatively inexpensive rate. It wasn't insured by transactional risk market, it was insured by the title insurer. Fundamentally, the underlying risk here was a challenge to the title. We were able to offer both a warranty and indemnity suite to the buyer, insurance policy, and cover for this specific legal contingency, allowing our seller to walk away from this deal with limited residual value. The next example threw off, this was a refinery business based in Africa, 9 assets with a value of 800 million. Obviously, it was very, very sensitive around some ecological underlying risks, which had been identified. There'd been historical contamination. The seller had undertaken extensive remediation exercise, but there was an inherent risk that there could be a further seepage or pollution event, which would put the buyer at significant financial risk. 2 options here. How do you deal with the legacy a number of issues here. How do we deal with the legacy contamination issues? How do we deal with any potential liabilities to not only the proximate neighbours, but the community at large, the water source? An insurance policy was sourced. We were able to put together a policy for $50 million and provide the buyer with, again, the W&I insurance to wrap the warranties the seller's given and that indemnity that they'd been requesting from the seller. And next slide, please. I think it's back to you, Simon or Conrad.
Thanks, Neo. Disembodied voice of Simon. Thanks for that. That was great. Got one question that's come in for you, Neo, if I can stick with you. I'll read it out to you. Are the terms of an insurance contract in these transactions standard? And who is the subscriber for the insurance? Is it the seller, the buyer, or both? So who is the insured party?
So first one, are the terms standard? No, they're not. Every single policy is bespoke to the underlying transaction. So a lot of the work Conrad and myself would do at the outset is discussing the structure, the warranties, what scope of cover you would need. What is standardized across any insurer are the belt and braces, the general terms and conditions of the policy, but all of those again go through quite a diligent and robust negotiation process, as they tend to be turned by the broker and the lawyers and the client themselves many times. But I think fundamentally the point is these policies are bespoke to the commercial agreement between the parties. In terms of who is the insured, there is always a preference, and I'd say 99% of the business we do, the insured is the buyer. This goes back to the underlying motive, which is the seller's looking for a clean exit. Obviously, they don't want the policy. To the extent the seller is the insured, they have to stand as the first line of defence, and then the policy indemnifies them. Where we structure this for the benefit of the buyer and the buyer as the insured, the buyer would bring the claim immediately against an insurer and have recourse against that insurer. Did that cover it, Simon?
Yeah, that's great. Thanks, Neo. One other question, if I may, and then I've got one question for Rob. This product sounds like the panacea, Neo, as you're describing it. It sounds like it's a soft market, so it's great value. 28 very creditworthy insurers can provide the product. You can negotiate whatever warranties you like with the market. It almost sounded like you certainly don't need to be stuck to the warranties that are in the underlying document. The seller might even be insolvent and this responds. Are there any limitations to the insurance? It sounds almost too good to be true.
So I fear I may have oversold it here. No, it's not. It's not a panacea, and it's the first conversation we would have with clients on a call and their advisors. There are certain areas that will. Firstly, can you negotiate your warranties, and can we go to the market with the most aggressive set of warranties? Yes. All these insurers are ex-corporate lawyers. All our teams tend to be ex-corporate lawyers or tax lawyers. They will go through an exercise of what's market and what's not market, and there will be a discussion around some of those. So the end result of that market exercise, if we go to 28 insurers, is to present a report that sets out the findings of the market exercise. The premium, I don't want to frighten anybody. I tend not to focus on the premium as the first point. I tend to focus on what are the insurance comments against the warranties. And those comments will fall into three baskets, which are covered, excluded. And what would be excluded? It could be an operational risk that the target company already has insurance for. It likely is, if we've had a discussion already, I would be giving you a one-page report that sets out, due to the nature of that business and jurisdiction, what would be excluded. So I'm thinking immediately money laundering, any warranties or warranties as to no incidents of money laundering, fraud or bribery. That is an area that typically gets kicked out, excuse me, not as a compliance question, as an act, because insurance can't stand behind fraudulent conduct. Or the third scenario is we're prepared to cover that warranty, but on the following drafting. So the insurers may take a different view on the drafting. Now, if we've done our job properly and we've done it strategically, we will be doing that exercise either before it's being presented from seller to buyer as a SBA they're prepared or warranties they're prepared to offer, or from the buyer to the seller as these are the warranties we've negotiated with an insurer and we need to give them to you. What does, just to be mindful where it isn't a panacea, is the insurers, anything that is disclosed in the due diligence reports, and you've had your top advisors go through all these matters, and you have certain tax matters that are identified as medium high risk. These are items that are a strict liability. They're not conditional on, they're simply a discovery risk. They're not conditional on an interpretation of law. It's a case of if the authorities come knocking, then you have to pay. Those would typically be areas that fall outside the scope of cover. Some of them can be negotiated, some of them can be underwritten, but matters that are disclosed and that you have the opportunity to negotiate with a seller, insurers would tend to look to you to do that commercially. The examples I've given in the case studies, they were, yes, identified, but they were matters that could be underwritten due to the risk profile information available and could be insured. And they were matters that we chose to insure because the seller preferred to pay the premium than have a 250 million indemnity for the next 7 years.
Great, thanks, Leo. So not quite a panacea, but it sounds like still pretty good aspirin for the problems that might ail you in an M&A transaction.
Yeah.
Rob, a question for you just to finish off, if I may. When you were talking, you talked about, I think you used the phrase, a brave new world in terms of the market and the investors that are out there. What type of investors are you actually seeing looking at these power and infrastructure transactions that you're working on, and has that changed in the last few months?
So I don't think it's maybe changed. I think it's just people have had to reassess or reset their expectations. I think there has been some pullback from certain types of investors who are less open to this infrastructure class. But I also believe that other investors are desperately looking for, and I'm talking more institutional investors. Institutional investors aren't getting quite what they want from the normal investment portfolios out there listed and other unlisted sort of asset classes. And now they're looking for somewhere where they believe they will get a higher return relative to the market. We often get calls from people phoning in from the US or the Middle East saying, I'm a new investor on the block and I'm here and I'm keen to get involved in this project and that. And then you say, well, what are you looking for? Anything? And you say, well, I need to be more specific. You know, I've got a project in Nigeria. Oh, no, don't do Nigeria. You know, where are you going to? And then we slowly evaluate it. And yes, they're looking at buying a Anglo-American share on the listed stock exchange. You know, so once you go through their risk appetite. So I think there's a lot of people who believe that Africa is less risky than it is. So I think a lot of those investors come in thinking they have opportunities, but to be honest, unless you have that risk profile or your understanding of the market or your understanding of the asset class, it's unlikely you'll invest. But then we are also seeing a number of private sort of house or company offices or private family offices, I think is the right term, who are coming into this market looking for higher yield type investments, and because they probably have specialist skills that they can hire in, they're happy to try and understand what the dynamics of a storage facility are. So we're seeing those sort of players definitely come to the market, and you're obviously working with a few, and we're working with a few sort of existing operators who are now also setting up capital funds, who are also trying to invest in sort of ancillary service offerings or related party type infrastructure that maybe they weren't in previously. So I would say there's definitely a lot more money than good projects. I'm not sure that all the money is willing to take the risk when it gets down to the last discussion point and you need to make the credit approval. But you know, we believe that at least there is sufficient opportunity and funding and investors out there to make sure that a good asset can be sold at quite a significant premium if the sales process is undertaken with some rigor and also not too unrealistic in terms of the valuations that are set out there. Thank you.
Great stuff. Thanks for that, Rob. And with time running, I'll hand back to you, Conrad, just to say goodbye.
For a farewell. Thank you very much, Rob, and thank you very much, Nao. That was very, very helpful indeed, and thanks for taking the time to prepare for the session. And thanks to you all for joining as well, and apologies for going slightly over our allotted time period. Just a quick reminder about what's coming up, and please don't forget to register for future events. We hope to see you there. And for that, farewell.
Thank you, Conrad. Thank you, team.